All right, 9:22 now on a Monday morning. We're at the midway point. Here it is, early July of the year. And when it comes to your finances, you got to ask, okay, how have I been doing, and what do we need to change for the second half of the year? Paul Schatz from Heritage Capital back with us today. Nice to have you here.
Good to see you.
I got about 8 hours worth of questions for you, and we're gonna
Fire
narrow it down
away.
to 4 minutes. How are we doing this year?
Markets are mediocre at best, up a couple of percent in the stock market. The bond market, which many more people have money invested in, is having a pretty rough year.
There are often, we do stories here on Fox 61 all the time, that there will be some economic indicator that says, head for the sidelines. Do we buy into those, or should we just be staying the course of what we've been doing?
It takes a lot to kill an economic recovery. And the recovery has been very uneven. And we're 10 years into this now. Recoveries don't last forever. It is if this is a football game, you're in the fourth quarter of the economic recovery. It's going to end.
Yeah.
The heroin, if you will, from tax reform, tax cuts, probably gets us into early to mid-19. But then, as I've mentioned here a couple times with Tim, I've got serious concerns from mid-19 to mid-20 that awful lot has been done and we're in some trouble.
So that's a year away now.
Right.
So what can we be doing the second half of 2018 and leading up to that to either minimize the hemorrhaging or prepare for something that, look, a lot of the folks who have been believing in the bear market have been expecting this for a while, and it has not come to fruition. So what do you do? How do you prep?
So in this day in 1932, the Dow bottomed at about 41.
Okay.
Having been down 89% during the Great Depression.
I'm familiar with that, yeah.
But so if you're the longest of long-term investors in the stock market, you're going to get 9% a year. But it's not an even 9% a year. We're 10 years into this. The average investor should pick an allocation to stocks and bonds that they can tolerate when bad times come. I'm normally a very positive person, but sometime in the next 2 years, 2.5 years, we're going to have 6 to 18 month period where stocks go down 30%. That's the normal cycle. If the average person cannot stomach to watch their portfolio go down, then
have we met? Right.
So then you need to change the risk in your portfolio. You can't have all that money in stocks. You need to have other things, like you need to have some real estate or REITs. You need to have perhaps even some cash. Or you need to find stuff that hasn't appreciated, hasn't gone up like Facebook, Amazon, Netflix, Google.
Sure. Let's talk about real estate. You mentioned it. Rates are still relatively low, starting to jump up a little bit with a couple of percentage hikes. But is it still a good time to say maybe I should be investing in my home as opposed to, say, playing riskier, more aggressive stocks?
There's not a right or a wrong answer, which I'm shocked. You're shocked that I would say that. Here's the however. If the average person has everything they have in stocks, that's a recipe for disaster at some point.
Right.
Real estate is very segmented around the country. You've got pockets of unbelievable strength, and then you've got Connecticut. So the best thing anybody can do is always invest in themselves. But remember, your home is really not an investment. That's a home.
Right.
A second home, a rental property, that's 4 walls and a roof you're trying to make some money on. But clearly, if you're over leveraged, if your mortgage is much more than you can handle, and you've got money in the bank account, you can certainly pay down some principal. And this is, I think, the end of the real refinancing boom. For those looking for that last grasp to, geez, let's refinance. I think if recession hits in mid-19 to mid-20, I think rates on mortgages will go lower. That'll be the last opportunity for the next probably 10 to 15 years to get good rates.
I still think about what the APR was for my parents' home back in the last 20, 30 years.
Mid-upper teens.
Right. So even if it jumps, it's still a bargain. We got to go.
Thanks.
Let's stay here because I got about 7 hours and 56 minutes
I got
of questions left.
Here all day.
Paul Schatz, thanks so much as always. We appreciate you.